I received a question from someone in the comment section on one of my previous videos the other day, and basically they were asking um, how to handle the high implied volatility for companies. So basically, they were wanting to know if they ignore, do they just ignore the implied volatility or plan for it to go higher later or whatever. It was basically a question that's kind of multi-layered, and I let that person know that I would do a video and try my best to address their answer to that question. So I'm going to talk about how to handle implied high IV for companies, and with the markets being bearish, how those things kind of work together. But thanks for watching. Please consider liking, sharing, subscribing to my channel. I really appreciate it. If there are any topics or questions or tickers that you'd like for me to address, leave them in the comment section. I'll be happy to do so if I'm able, or point you to a better resource. Um, excuse me. If you haven't already, make sure you stop over at chartsandpriceaction.com. Check out a couple of my latest offerings with By the Hood University, where we talk about price action, a lot of its nuances, and then I also discuss some of my uh, guidelines from my trading Bible. But let's go ahead and talk about how to navigate implied volatility in these markets. All right, so first let's talk about VIX. So implied volatility is in my opinion the most important piece to trading and investing. You can't escape it. If you're in these markets, you can't escape the influence that implied volatility has on your capital, on your portfolio, and just over the markets as a whole. So it's important to be able to gauge sentiment when you look at VIX. Um, and the main thing that you're looking for when it comes to VIX is whether we are in a risk on or a risk off um, environment. And what it means to be risk off is just basically means that investors and traders are reducing their exposure. They're taking less risks with their money. So it's more about preserving capital and things like that. So you may see, money fleeing from the markets like we have seen for the past several months at this point. Risk on means the exact opposite of that. People are taking more risk with their money. They're exposing more, or they increase their exposure to the markets due to what they're reading as far as implied volatility is concerned. So let's not get this confused with the implied volatility of equities. So you have VIX, which is pretty much the volatility of, the S&P and the broader markets, but each company or each equity also has its own implied volatility. So I can't look at VIX and say, oh, volatility is high for, uh, let's say Papa John's. You know what I'm saying? So you have to look at Papa John's and evaluate its volatility to determine whether Papa John's implied volatility is high or low. And so one thing that we're looking at here, and this is a daily chart of VIX. I've talked about VIX. I've been talking about VIX regularly for the past few weeks. But one thing that I didn't mention is that, well, actually, I mentioned this in a live that I did with Diamond Dave. So make sure you guys go and check that out. That VIX is trading toward the lower end of its implied volatility range. So you can see over here, since the end of May, VIX's implied volatility has been increasing. So if you look, I drew some price levels to show pretty much where VIX's implied volatility tends to be, right? And so you can see right here in May, it was really below where it typically is, which means that there was a higher possibility that VIX's implied volatility would rise versus the probability that it would just continue to fall. So that let us know that VIX was trading toward the low end of its typical range. So we know then, it may be best to reduce your exposure to, the overall markets. Definitely get your hedging plans in place, and, just set a plan for um, mitigating the risk. You know what I'm saying? And like I said, there are many ways in which to do that. So VIX is trading on this gradual uptrend. Its implied volatility is going up. So these are the makings of a risk off environment. But let's keep that in mind. So with VIX hitting this area here, so it's important to know where the buying and the selling is on VIX, and that can help you with sentiment as you trade, whether you're trading on a day-to-day basis or whether you're trading, some swing trades or leaps or whatever. So let's say, I am trading swinging short term. So, maybe my positions are no longer than 30 days or so. So for me, in looking at VIX, the first thing that I'm doing is saying, where is VIX in relation to this pattern that it's been trading in for the past several weeks, right? So if VIX is down here, I'm not bullish at all for the most part in the overall markets, right? Because what VIX has shown me is that every time it hits this lower purple trend line, it bounces, so it goes up. So VIX, the volatility is increasing. So, I'm in a situation where I'm reducing risk, right? I'm thinking more about hedging and preserving capital. I'm not, taking, the chances that I would take if VIX was up here. You know what I'm saying? And on the flip side, if VIX is, let's say I look at VIX and it's up here toward the upper end of this range, then I'm a little more comfortable with grabbing a bullish position. So that's just a quick little example. Of course, this is not investment advice or anything like that. This is just what I've been doing lately. But let's look at. Let me choose. I'll just say Google, for example. Let's look at Google. All right, so you see Google for the most part is trading toward the. Looks like it's trading toward the high end of its range. Let me see actually where the IV rank is for Google right now. 65%. So yes, it's over that midpoint of 50%. So it's headed toward the upper end of its range in terms of how high the implied volatility on Google typically goes. Um, so higher probability that Google's implied volatility would decrease versus increase from where it is now. So let's say, I am looking at, I want to see if I can find something with a high and a low implied volatility. Let me check out Tesla and see where Tesla's implied volatility is right now. Uh, okay, 81%. 81%. All right. Okay, so we see that Tesla's implied volatility is pretty high right now. It's sitting at 86%. And you can see that the majority of the time, um, Tesla's implied volatility is lower than what it is right now. So that lets me know that Tesla's implied volatility is pretty high. So let's say that I am looking at Tesla and I'm considering a trade on Tesla. Maybe it could be a day trade, a swing trade, or whatever. So I can approach this in a couple of different ways. And one thing that you have to keep in mind is what happens to premium on an option when implied volatility rises or falls. So if I'm in a position, so let me answer that question. So when implied volatility on an equity rises, that gives value to the premium. And when it falls, that takes away from that premium. So one thing you have to think about is the strategies that you can employ when it comes to implied volatility. So a lot of people, a lot of us just use calls and puts, just straight calls or straight puts. But the thing about calls and puts is sometimes they're not the best way to profit uh, off of a strategy. They're not the best ways to mitigate the risk of implied volatility. I don't know about you guys, but I have been in situations for sure where I've been on the right side of the play, but because the implied volatility is too high, I've lost due to that drop in implied volatility. So what you can do is, say let's say I'm bearish on Tesla, and the implied volatility, or let's even say I'm bullish on Tesla, and the implied volatility is high, as we see here. What I could do is sell some premium, right? Because that tends to be a strategy where implied volatility can work in your favor, right? So so Tesla, let me see, let me look at all right. So what I could do instead of buying calls on Tesla, because a call, keep in mind that a call on Tesla, I'm bullish. I may be bullish on it, but what I'm not thinking about is that high implied volatility. If I buy a call on Tesla and the implied volatility drops, there's a chance that I could lose money. But let's say I sell a put instead. Stay with me here. Sell a put. So selling a put is a bullish strategy, but it's a bullish strategy that takes advantage of that drop in implied volatility. So that's one thing that you can do in this type of environment is learn how to or learn about premium selling, learn some advanced strategies instead of just your regular calls and puts. They all have their place, but really when it comes to when you're really employing risk management, implied volatility is the most important piece of your strategy. And at this point forward, if you have not been considering implied volatility, change it. Change it right now, because that's the key. Because implied volatility is your guide to sentiment. How should I navigate the markets? How should I navigate this specific ticker that I'm looking at? Know what's going on with the implied volatility, no matter what equity you're trading, and each equity is going to be different again. And also know what's going on with VIX, and that'll tell you, should I be selling premium or should I be buying? You know what I'm saying? And so typically you want to be buying as that implied volatility is rising. And when I say implied volatility, I mean the equity, the equities implied volatility, not VIX. When I mean VIX, I'll say VIX, but implied volatility, when it's rising, typically you want to be on the buying side. But when it's falling, you do not want to be on the buying side. You do not want to be on the buying side, because the higher the risk, the lower your probability of your contract expiring in the money. You know what I'm saying? So let me see if I can find something with low implied volatility. And I really don't know, so I'm just gonna kind of flip through a few tickers, and if I can't find something, then it's all good. um That's not low enough for me. Still not low enough. No, not. Um, I literally can't think of anything. Um, all right, so I can't find anything that has really, really low implied volatility at this time, but let's see if I can just kind of talk through an example. So remember, I said that when you find an equity that's at the lower end of its implied volatility range, it has a higher chance of going up, right? And so that gives more value to the premium on your options contracts. So you want to be on the buying side. You know what I'm saying? Whether you're buying puts or buying calls. However, as I just demonstrated with the Tesla example, when it's at the higher end of its range, you don't want to be buying, right? Because that implied volatility drop is going to take a lot of premium, a lot of value from your option contract. So, those are some important things to keep in mind as a trader, as an investor. Whether you're trading stocks, whether you're trading options, doesn't matter. Implied volatility is the most important concept that traders need to learn and get comfortable with, and start learning about some of these more advanced strategies. And of course, most brokers are going to require a margin account to for you to be able to be on the selling side of the options game. So just keep that in mind. If you're in like a level 1 or level 2 cash account, you can't do any type of spreads, any type of selling or to collect premium. None of that. You know what I'm saying? So to sum it up, implied volatility is your most important concept and tool when it comes to trading and investing. It allows you to gauge sentiment not only on the overall markets but also on each individual ticker, and so it also lets you know whether uh, it's your guide to what strategy you should employ um, in approaching that ticker in a risk-based way. So everything that you should do when you're trading should be based upon risk. You should assess the risk of the equity, assess the risk of the market, and assess your own risk tolerance before you jump into a situation, and your plan should reflect all of those things. But I appreciate you guys for watching, and I hope this video was helpful. I appreciate Drop 16 for asking the question. It's a very important question, but again, like I said, I felt like I needed to create a video in order to properly address the question. But if you guys have any other questions, I'm happy to do my best to answer them or point you in the resource in the two resources that may be better able to handle your question. Um, Again, chartsandpriceaction.com. Check out my latest course offerings, and I'll catch you guys in the next video. Thanks for watching.